Chapter 12, Statement of Cash Flows. Now, our study objectives in this chapter is to look at the usefulness of the statement of cash flows and distinguish the three parts of the cash flow statement: the operating part, the investing, and the financing activities. We're going to look at number 4, prepare a statement of cash flows using the indirect method. And number 5, of course, the purpose of this is to evaluate a company based on the cash flow statement. Now, as I said, there are 3 sections to the cash flow. There are operating activities, which is your income statement. Your income statement is a statement of operations. This is what I'm in business for. I earn revenue, and I pay expenses in order to earn that revenue. That's what my operations are. And so when I earn revenue, that's cash that comes into the business. When I pay expenses, that's cash that goes out of the business. So the net profit for the time being is close to what net cash flow would be from operations. Then there are investing activities. That is, I put money into investments, fixed assets, long-term assets. I buy plant and I buy equipment. Productive assets that help me generate my revenue. Then there are financing activities. I either raise the money by borrowing it and increasing my long-term liabilities, or selling shares, stockholders' equity. So those are the 3 main categories of a cash flow statement. The statement itself: items, cash inflows from the sale of goods or services, from interest received or dividends received. Cash outflows: I pay my suppliers cash, my employees cash. Government taxes: the people I borrowed money from, the lenders, the banks, I pay them interest. And there are other host of expenses which are cash flows. Investing activities: if I sell property, plant, and equipment, that's cash coming in, cash inflow. If I sell some of my debt or equity investments or marketable securities, if I collect on principal of loans, those are cash inflows from investing activities. Cash outflows: if I purchase property, plant, and equipment. And most of the time that would be the major cash outflow. In financing activities, if I sell common stock or I borrow money on long-term debt, those are cash inflows. When I pay the shareholders dividends, that's a cash outflow. When I pay back the debt, that's a cash outflow. So those are some of the classification of cash flows. As I said, the statement is in 3 parts. The first part is operating activities. The second is investing activities, and the third is financing activities. There are 2 methods. Now, the PowerPoints will go through both methods, but actually we only concentrate on what's called the indirect method. That's the simplest and most often used. The format: you can begin to see that the format starts with cash flows from operating activities, and you list the individual items. Then cash flows from investing activities, and again you list them. So out here you have operating and investing and financing. Now, the net increase or decrease in cash is calculated by adding and subtracting these 3. And that difference would be the difference between the cash you had at the beginning of the period and the cash you had at the end of the period. Now, there's a new item here. It's called non-cash investing and financing activities. That generally we can ignore for the time being. Okay? Now, let's go back to an illustration of the indirect method of preparing a statement of cash flows. We start with the income statement. This is a statement of operations. Here's our revenue, and these are our expenses. Now, generally the revenue would be cash, of course, all cash. But not all expenses here are cash outflows. You'll notice that one called a depreciation expense. That means that I've allocated the cost of equipment or building in the past over a number of years, so that I didn't have to pay that expense. Same with loss on sale of equipment. That is just an accounting entry. That is, if I sell my equipment for less than the book value, I say it's a loss. Now, the sale of equipment is investment cash inflow. But this loss is just sort of like an artificial accounting loss. It's not a cash outflow. So you see, when I look at my net income down here of 145, that generally is cash in minus cash out. But not all these items are cash out. So to convert my income statement to how much cash did I generate, I add back depreciation and loss on equipment. Now, the other statements I use are the balance sheets. I compare last year to this year. Now, this is the cash balance, or let's just take accounts receivable. This is the accounts receivable at the end of 2011, which is also the beginning of 2012. So through the year 2012, my accounts receivable decreased by 10,000. My inventory increased by 5. My prepaid expenses increased by 4. And land and building and all of that increased. So you can see we analyzed the balance sheets beginning of the year or the end of the year to see the change in these assets, because these change represents cash, either cash inflows or cash outflows. There you have for the liabilities. Now they tell us that depreciation expense was $6,000 for building and $3,000 for equipment. They say the company sold equipment, book value $7,000. That's cost less accumulated depreciation, but they sold it for $4,000, so that's why they had a loss of $3,000. It's not really a loss. The cash inflow was $4,000, but because the book says that the book value was $7,000, we have to show a loss. We obviously issued $110,000 in long-term bonds. That's up here. You can see that went from 20 to 130. Building cost in 120 was purchased, so in the assets you'd see that. Equipment cost 20,000. Issued common stock of 20, that's there. And declared a dividend. Now that's a little tricky, but they'll tell you that dividends a cash outflow of 29,000. First we look at operating activities, step 1. We look at how much cash was provided by operations, that's revenue, and how much cash was used by operating activities, that would be expenses. So we take the net income or loss and we add back non-cash expenses, depreciation, amortization, depletion. We deduct any gains or losses on the sale of any equipment and any change in non-current assets. That rarely happens, but here we go. First question, which is an example of cash flow from an operating activity? Payment of cash to lenders for interest, receipt of cash for the sale of capital stock, payment of cash dividends to the company, none of the above. Payment of cash to lenders for interest. Now, depreciation expense, as I explained before, is a non-cash expense. So I take the net income that I'm reporting in my income statement and I add back the depreciation expense. So I say now, cash was 145, but to get down to 145, I deducted 9,000, which was not a cash expense. So I add that back. And I do the same thing with any gain or loss on equipment. In this case, I had a loss of 3,000. So I add that back. So from operations, if you look back at our income statement, revenue would be with my income coming in. And when we subtract all the cash expenses, we actually have a net cash inflow of 157,000. That is, revenue, cash from revenue exceeded the cash expenses by 157,000. Now we look at all the current assets, or the non-cash current assets. We look at accounts receivable on the balance sheet. And we say, okay, look, it decreased. It was 30,000 at the beginning of the year. And receipts from customers and revenue, we end up with 20,000. So obviously, the company adds the amount of decrease. Now, my accounts receivable went down, which means I collected more money this year than I sold in revenues. So the change in accounts receivable, a decrease, is a source of cash. We freed up cash. And so therefore we add that decrease back to the cash flow from operations. Next, inventory. You can see that inventory increased. So if I increase my inventory, then I use more cash to increase my inventory. So that is a use of cash. And the way I show that is I bracket it over here. I say, okay, the increase in inventory is a use of cash. You see the decrease in inventory is a source of cash. And I go through each one. The prepaid expenses increased, therefore cash paid for expenses is higher than reported, and the company deducts the decrease from net income. So therefore, an increase in prepaid expense is a use of cash, and I bracket that. Now I look at my liabilities. Okay, my accounts payable increased 16,000. Now if that increase, that means I'm holding back cash. So if my accounts payable increases, I'm holding on to my cash. You can understand that. And therefore, the 16,000 is a source of cash. It's looked at as a source of cash. There was a decrease in my income tax payable. Well, if I decrease my income tax payable, then I paid more this year than I did last year. And therefore, that is a use of cash. Okay, so there's a summary of the conversion of net cash provided by operation activities. Depreciation expense, you add back. Loss on equipment, you add back. Gain, you deduct. Increase in current asset account, you deduct. Decrease in current asset, you add. And the opposite is true for the liabilities. So that completes the step one, which is operating. Step two is investing and financing activities. The company purchased land for 110 by issuing long-term bonds. So if I issued long-term bonds, then that is a source of cash. So therefore, the net cash provided from operations we showed is 172. But if I purchased a building for 120, that's a cash outflow. If I purchase equipment, that's a cash outflow. If I sold equipment, that's that gain. Remember the gain and loss? I had the equipment book value 7,000. I sold it for 4. There's the 4,000. So I say I got 172,000 here from operations, which I just showed you in step one, and I consumed 141,000 in investing activities, and I generated, well, I sold some common stocks, so that's cash inflow. But I paid dividends of 29,000, so that's a cash outflow. So the net cash from financing is 9,000. So you see from operations 172, but 141 of that went to pay for investing in equipment. 9,000 went to pay for dividends. So 172 source, 141 use, 9,000 use gives me a net cash increase of 22,000. And if you look back on the cash item of the balance sheet, you would see that cash at the beginning, 2011, beginning in 2012 was 33,000, and cash at the end was 55,000. All right, and therefore you can see that the cash went up by the 22,000, and that's how we complete the investing and financial statements. There's your statement of cash flow. Cash flow from operations, net income, add back depreciation, loss on equipment, decrease, so we come up with the 172. Cash purchase investments, and so on. And that's the investing and financing activities. That's what you have to look at. Statement of cash flow, the indirect method. The net change in cash is cash on a statement of cash flow with a change of cash account reported on the balance sheet to make sure the amounts agree. That's that. Thank you.